Right now the market feels off, like something isn't lining up, and that weird feeling is confusing a lot of people. Inflation is still hanging around, interest rates are much higher than what everyone got used to, consumer debt keeps climbing, and stocks are priced like nothing could ever go wrong. On paper, this looks like a setup for a crash. But instead, the market just keeps moving higher. Every dip gets bought, every scare fades, and people are left wondering how this is even possible. Here's the truth. Markets don't move based on how bad things look today. They move based on expectations. Wall Street isn't trading the present, it's trading the future it believes in. As long as investors think inflation will cool off, rates will eventually come down, and the system won't let everything fall apart, prices can stay elevated longer than feels logical. That's why bad news keeps getting brushed off. Hot data drops and people say, yeah, but we knew that. Weak numbers come out and buyers still show up. This isn't manipulation or some secret plan. It's psychology. When most people are already invested, they want to believe everything will be fine. Nobody wants to sell early and miss the next rally. So risk gets ignored, danger gets explained away, and confidence quietly grows. And that's the key thing to understand. The market doesn't crash when fear is high. It crashes when confidence finally breaks. One of the biggest mistakes investors keep making is assuming markets crash because things look bad. That's almost never how it actually goes down. High inflation alone doesn't trigger crashes. Massive debt numbers don't either. Even markets that are insanely overpriced can keep running way longer than anyone expects as long as confidence stays intact. Crashes happen when belief breaks, not when headlines look scary. The moment investors stop trusting that someone will step in to buy tomorrow, everything changes fast. Selling stops being patient and starts becoming urgent. Until that point, risk feels normal. Comfortable. Almost boring. And here's the dangerous part. Every time the market shrugs off another scare, that comfort level rises. People start feeling like they've cracked the code. Volatility feels temporary. Losses feel recoverable. Dips stop feeling risky and start feeling like easy money. That's when leverage quietly sneaks in and caution fades into the background. The market becomes fragile without ever looking weak. From the outside, everything looks strong. Prices are up. Pullbacks are shallow. Confidence is high. But under the surface, positioning gets crowded and expectations get stretched. That's why the biggest crashes don't come out of panic. They come out of calm. When everyone feels relaxed, when risk barely registers, when people stop asking what could go wrong, that's usually when the system is under the most stress. Markets don't punish fear nearly as much as they punish overconfidence. And when that confidence finally cracks, it doesn't crack slowly. It breaks all at once. A huge reason the market keeps holding together right now is liquidity, and most people seriously underestimate how powerful that is. There's a non-stop flow of money coming in from retirement accounts, index funds, pensions, and automated strategies that don't care about fear, headlines, or valuations. They just buy. Every paycheck, every contribution, every rebalance adds fuel to the system. On top of that, big institutions don't have the luxury of sitting in cash waiting for the perfect moment. They've got benchmarks to track, clients to please, and careers on the line. Staying invested isn't optional, it's part of the job. All of this creates a steady bid under the market, even when sentiment feels shaky. Over time, this conditions investors to believe dips are safe. Volatility starts feeling like background noise instead of a warning sign. Risk feels manageable. Controlled. But liquidity cuts both ways. As long as it's flowing in, markets feel stable and calm. The moment it slows down or reverses, things can change fast. What once supported prices can suddenly amplify losses. Buyers disappear, spreads widen, and selling feeds on itself. That's why crashes feel sudden. It's not because risk wasn't there. It's because liquidity masked it. When the flow dries up, reality hits all at once. Markets don't slowly fall apart. They drop when the support underneath them quietly disappears. Inflation plays a sneaky role in why markets stay up longer than they should, and a lot of investors miss this completely. When inflation rises, companies often report higher revenues even if real growth is weak. Prices go up, sales numbers look bigger, and earnings appear stronger on paper. That makes stocks look justified, even when nothing meaningful has improved. It's basically inflation dressing up mediocre performance and selling it as growth. At the same time, cash starts losing purchasing power, so sitting on the sidelines feels like a guaranteed loss. That pushes more money into stocks, not because they're cheap, but because everything else feels worse. Investors tell themselves equities are an inflation hedge, and sometimes they are, at least short term. That extra demand keeps prices elevated and delays corrections. Instead of a sharp reset, inflation spreads the pain slowly. It eats away at real returns while keeping nominal prices high. Because the damage is gradual, it doesn't trigger panic. People don't freak out over slow erosion. They panic over sudden drops. That's why inflation-heavy environments can feel stable while quietly increasing risk. By the time people realize what's happening, valuations are stretched, margins are under pressure, and expectations are way too high. Inflation doesn't remove risk from the system. It hides it. And hidden risk is usually the kind that does the most damage when it finally shows up. Almost every major market crash follows the same basic pattern, even though the details always look different in the moment. First comes denial. Risks are obvious, data looks shaky, but prices keep rising so nobody wants to fight the tape. Then comes normalization. High valuations stop feeling extreme. Heavy leverage feels standard. Volatility feels manageable. People adjust their expectations and tell themselves this is just how markets work now. That's when confidence quietly takes over. The final stage is the break. It usually doesn't start with some massive disaster. It's often something small, something that shouldn't matter on its own, but it hits a market that's already stretched and crowded. Confidence slips, buyers hesitate, liquidity pulls back, and suddenly the floor drops out. Selling feeds on itself because everyone realizes at the same time that support isn't guaranteed. That's why delayed crashes tend to be faster and more violent. The longer risk gets ignored, the more pressure builds underneath the surface. When it finally releases, there's no slow unwind. Markets reprice in days or weeks what they ignored for years. This is why timing crashes is a losing game. The goal isn't to predict the exact moment things break. It's to understand how confidence forms, how it fades, and how quickly it can flip. Fear doesn't end bull markets. Complacency does. When everyone feels relaxed, when risk feels distant, when people stop asking what could go wrong, that's usually when the setup is complete. The market doesn't warn you with panic. It warns you with comfort. Another thing that keeps people confused is how confidence feeds on itself inside markets. When prices keep going up, people don't just feel richer, they feel smarter. Winning feels earned, not lucky. That changes behavior. Investors start trusting their instincts more than the data. Risk that would have felt uncomfortable a year ago suddenly feels reasonable. The longer this goes on, the more people anchor their expectations to recent performance. If the market bounced the last 5 times, it'll bounce a 6th time, right? That mindset spreads fast. Social media, headlines, and casual conversations all reinforce the same message: staying invested is the safe move. Anyone who's cautious starts feeling dumb or left behind. That social pressure matters more than most people realize. It pushes investors to chase performance and ignore warning signs. Over time, skepticism disappears. Nobody wants to be the buzzkill. Everyone wants to be on the winning side. But this is how markets lose their margin of safety. When too many people believe the same thing, the trade becomes crowded. There's no room left for surprise. If something challenges that shared belief, reactions get extreme. Confidence doesn't fade gently. It flips. And when it flips, people don't slowly adjust their positions. They rush for the exit at the same time. That's why crashes feel emotional and chaotic. It's not just about money. It's about identity. People aren't just losing capital, they're losing the story they told themselves about how the market works. Policy and intervention play a bigger role in modern markets than most people want to admit. Over the years, investors have been trained to believe that if things get bad enough, someone will step in. Central banks cut rates, governments roll out stimulus, and liquidity gets pumped back into the system. That expectation alone changes behavior. People take more risk because they believe there's a safety net underneath them. Losses don't feel permanent if you think help is always coming. This creates what's often called moral hazard, but in real terms it just means people push things further than they normally would. The longer intervention works, the stronger that belief becomes. Markets stop pricing risk honestly because they don't think they need to. But intervention isn't magic. It doesn't remove risk, it just shifts it around or delays it. Each time support is used, the system becomes more dependent on it. Eventually, the cost of stepping in gets higher and the effectiveness gets lower. That's when things get tricky. If policymakers hesitate, move too slowly, or choose not to act, confidence can crack fast. Investors aren't just reacting to the problem itself, they're reacting to the idea that the backstop might not show up this time. That uncertainty is dangerous. Markets can handle bad news. What they can't handle is doubt about support. Once people start questioning whether the safety net is really there, risk gets repriced in a hurry, and things that felt stable can unravel way faster than EXP. Another reason markets stay elevated is because timing fear is hard, and most investors have been burned trying to do it. People remember selling too early, watching prices keep ripping higher, and feeling stupid for sitting on the sidelines. That memory sticks. It creates hesitation. Even when risks are obvious, investors delay acting because they don't want to repeat that pain. So instead of stepping back, they stay in and hope for the best. Over time, that hesitation turns into acceptance. People stop trying to time downturns and start telling themselves that riding it out is the smart move. Long-term thinking becomes a shield against short-term risk. And while that mindset can be healthy, it can also blind people to changing conditions. Markets don't care about your timeline. They care about positioning and expectations. When everyone is leaning the same way, the risk isn't missing upside, it's being trapped when the exit gets crowded. Fear doesn't show up as panic at first. It shows up as silence. People feel uneasy but don't act. They wait for confirmation. By the time confirmation arrives, prices have already moved. That's why downturns feel unfair. It's not that the signs weren't there. It's that acting on them felt harder than ignoring them. Comfort delays action, and delay is what allows imbalances to grow until they can't be ignored anymore. What really catches people off guard is how fast things change once momentum flips. Markets don't gently warn you when conditions shift. They move from calm to chaos in what feels like no time at all. One day, dips are getting bought and everyone's chilling. The next, buyers hesitate, volume dries up, and prices start sliding harder than expected. That's because markets are driven by behavior, not just numbers. When confidence breaks, people don't slowly rethink their strategy. They react. Algorithms kick in. Stop losses trigger. Funds rebalance. What felt like a small move snowballs into something bigger. And suddenly, everyone realizes liquidity isn't guaranteed. That's the moment when narratives flip too. The same headlines that were ignored on the way up become reasons to sell on the way down. Optimism disappears and gets replaced with urgency. The market doesn't wait for clarity. It reprices uncertainty instantly. That's why crashes feel violent. It's not just fear hitting prices, it's positioning getting unwound all at once. The longer a market stays calm while risks build, the more unstable it becomes underneath. Stability creates leverage, leverage creates fragility, and fragility creates speed on the way down. Most investors don't lose money because they didn't see the risk. They lose money because they underestimated how quickly sentiment can turn. Markets don't give you time to adjust when belief breaks. They force the adjustment on you. The real takeaway here isn't about predicting crashes or trying to time the perfect exit. That game almost always ends badly. The point is understanding how markets actually work when things look calm on the surface. Risk doesn't disappear just because prices are going up. Most of the time, it's building quietly underneath. Confidence feels good, but it's not permanent. It's fragile, and it can flip faster than most people are prepared for. The smartest investors aren't the ones who panic at every headline or chase every rally. They're the ones who respect uncertainty, manage exposure, and stay flexible when conditions change. They understand that markets reward discipline, not bravado. You don't need to be all in or all out. You just need to know when comfort is turning into complacency. Because that's usually the moment when the system is most vulnerable. When everyone feels relaxed, when risk feels distant, when the narrative sounds airtight, that's when it pays to slow down and think clearly. Markets don't end because of fear. They end because too many people forget that things can change. Staying aware, staying humble, and staying adaptable won't make you rich overnight, but it might save you from making the mistakes most investors only understand after it's too late.